Chapter 3, Financial Accounting. The Adjusting Process, Part 1 of 3. Chapter 3 continues the first two chapter conversations about the accounting process, about how accounting is related to business transactions and accumulating those transactions around the accounting equation to prepare financial statements for users to make decisions with. So we've already talked about what an accounting transaction is and how it fits into the accounting equation. We talked about the system called debits and credits that are used to apply to the double entry accounting equation of assets equal liabilities plus stockholders' equity. We've expanded stockholders' equity into the two parts, common stock and retained earnings, and we've expanded retained earnings into three parts, revenues, expenses, and dividends. Once the transactions are all recorded into the correct element, whether it's assets, liabilities, or stockholders' equity, once a transaction has been recorded through a double entry system, then you can see that all the debits equal the credits and it's time to prepare financial statements. But there's one step in between, and that is the adjusting process. So let's talk about the adjusting process. I want to do a quick review, however, of businesses and the fact that we study corporations, a reminder that transactions occur every single day. With a large corporation like Walmart, they're occurring every single second, and that we analyze these transactions using the accounting equation. Each transaction, as we've said, has two entries, and they are first recorded in a journal. And this is what a journal entry looks like as a reminder. There's a date, a description, and a debit and credit, and we can see how this journal entry has equal debits and credits, and then here's our explanation. Once the transaction has been recorded in the journal entry, after there have been several transactions, some companies do it once a day, some companies do it once a month. Then these transactions, sorry, got to remove the pointer. Then these transactions are recorded into a T account because this T account is easy to use. So as you can see here, we have the debit under utilities, and it is being recorded in this utilities expense. Move forward and remind ourselves of what a ledger looks like. A ledger is more of a T account system than the T account. So looking at this ledger and reminding ourselves, because we just did this in the last chapter, this is where the transactions are recorded, and this is the running balance, and this is the account number. Transaction of debit or credit and running balance. So the ledger looks like the computerized systems. The T accounts are the things that most people typically use. Let's talk then, to move ourselves forward, about the two methods of accounting so we can talk about what adjusting entries really are. Some small businesses use the cash basis of accounting. That means that as cash is deposited into the bank account, it's considered to be revenue. As cash is paid to pay the bills, it's considered to be an expense. And just for the record, by cash, we mean credit cards or checks or actual cash. Now, under the accrual method, and this is the one that's required by GAAP, and that's an extremely important understanding, and that is that the accrual method is required by GAAP. Under the accrual method, these are our rules. Revenue is recorded when earned, and expenses are recorded according to that matching principle we learned about in Chapter 3. Expenses are recorded whenever they are matching with the revenue, not when the cash is paid out. So some books actually will say revenue is recorded. So let's talk about the principles of revenue recognition. It's very basic for our introductory course. You record revenues when the services have been done or products delivered. So let's say you have a contractor and he says that he will build a deck. The customer might have to pay him up front before he even starts to build a deck. But the contractor doesn't earn the revenue until the services have been performed. Similarly, if we look at a customer that is buying something, they may call in advance and say, will you hold this item for me? I'm coming to pick it up. And they may even pay for it in advance. But until the product has been delivered to the customer, it's not considered revenue. Now, this sounds pretty basic and simple, but there's some pretty complex situations out there. For example, what if you collect all your revenue in advance? Or what if your customer pays you in advance? And these are all situations that have to be dealt with when we start talking about the accrual basis of accounting. So these revenue recognition rules relate to the accrual basis of accounting, not cash. So generally when we're talking about revenue recognition, we're talking about revenue being received in cash or accounts receivable. It doesn't matter. The rule is revenue is recorded when earned. Let's go to expenses. And this is where we get into our matching principle, which is such an important principle. Expenses are recognized when they help generate the revenue and they're reported in the same period as the revenue. So if a company pays 3 years worth of insurance in advance, after the first year they can only record 1/3 of that insurance as an expense because that's the period that the insurance was helping earn the revenue. This is also called the matching principle, where revenues and expenses must match. And so your net income or your net loss is properly reported on the income statement in the correct period. And that goes back to that Chapter 1 concept related to accounting periods. Adjusting entries are required to actually match these revenues and expenses. And so we can have accounts payable, accounts receivable. These are quirky things you won't find on a cash basis. So let me remind you then, periodicity, the matching principle, adjusting entries, all of these things relate to prior chapters. And as such, students have to remember what went on 2 or 3 chapters before. Okay, adjusting the records. Here's where we get into some interesting part. Let's talk about the fact that in Chapter 2, we looked at an unadjusted trial balance. And all we were doing was making sure our debits and our credits were equal. Here in Chapter 3, this is a chapter about adjusting entries. They're also known as adjusting journal entries, or AJEs. So adjusting journal entries are made to make sure that the accounts are updated or adjusted. And they're done when it's time for financial statements. So essentially the company will say, okay, we need some financial statements to take to the bank, or it's the end of the year and it's time for us to prepare financial statements. And so that's the time that the adjustments are made. For small businesses, frequently they have a bookkeeper and they have to call their CPA in or their professional accountant to come in and prepare these adjusting journal entries. Sometimes they're called adjustments, adjusting journal entries. So here's some examples. Supplies that have been used that were paid for in advance. We've already done that adjusting entry. You see that there were $1,300 worth of supplies and there's only $500 left. You have to make an adjustment. Prepaid rent has to be adjusted, and it's one of the adjusting journal entries that we have to prepare. Prepaid rent is recorded as times passed. So if you prepay 3 years worth of rent in advance, you recognize 1 year as a time. And I'm hoping, but this is new for each of you, that you remember that prepaid rent and supplies are both assets. And these assets become an expense. They are adjusted, as we talked about adjusting entries, and we'll record them as an expense when we do this adjusting entry. Another type of adjustment for the records is an accounts receivable that needs to be billed. Maybe you just sort of forgot, but because accrual basis accounting, you have to. Let's look at some other samples. Let's see, we've talked about supplies. These are expenses that we don't record every day. We've talked about prepaid insurance. Let's talk about unearned rent. It was an example for Net Solutions, and Net Solutions had a tenant that paid them rent in advance, and they could not record it. If you remember correctly, this is considered to be a liability. And so this liability is recognized as revenue as it's earned. There are lots of companies that have unearned revenue. Think of your tuition, for example. You pay in advance. Think about insurance. The people that receive your insurance money, if you use Allstate, they have a lot of unearned revenue on their books. Season football tickets, anything that has to be paid in advance is going to be a liability to the company that receives the money. Now, sometimes too, revenues and expenses are recorded at the end of the period, and this is sort of the, oops, I forgot to record my revenue or my expense, and it's time for me to do so. So we're going to be looking at all kinds of examples. This is called the adjusting process. I've got down, I love common sense, because it really is common sense. Adjusting process means updating at the end of the period, just based on common sense. And the common sense may be as simple as, okay, I paid insurance that's going to last a year, and 3 months have passed, so a third of that is an expense. And the journal entries that bring the accounts up to date are known as adjusting entries. Oftentimes, they're known as adjusting journal entries. We're going to be talking about two classifications of adjustments. These aren't important, but the theory of an accounting program always talks about the terms accruals and deferrals. So an accrual is when you record or accumulate an expense or a revenue, and you need to record it, but it's not yet been recorded. So you might have receivables or payables that need to be recorded. That is an accrual. We're going to accrue those expenses or accrue that revenue. Here's some examples. This is one related to the revenue. And here's one, for example, where you haven't recorded an expense yet. Maybe you have wages that aren't paid because December 31st happens on a Wednesday, and you don't make payroll until Friday. Well, you still owe 3 days worth of expenses for those wage expenses. So we'll learn how to do that adjusting entry. Examples of deferrals. Deferrals means delay. That's when the cash has changed hands before it's recorded on the income statement. Whoops, there's a typo. Unearned revenue is a deferral. You defer the revenue recognition until the revenue has been earned. And prepaid expenses are an asset. You defer the recognition of the expense until the proper accounting period. So both of these are perfect examples of matching. You record unearned revenue as earned revenue when it's earned. You record prepaid expenses during the expense period to which they apply, and they adhere to the matching principle. And here's an example of some deferrals. Here's one where we've recorded unearned revenue, and it shows the type of journal entry that we would record. And here's one where we would record an expense that has been allocated from prepaid expenses. That might be a supply. Supplies are prepaid expenses, and we will see lots of examples of those when we continue this with part 2 of 3.